Hello, my name's Charles Delastic. I'm the Managing Director of Blue Bond Tax Planning. We've been inheritance tax specialists for more than 18 years and have helped hundreds of clients save millions of pounds on their estate planning and inheritance tax planning. So today's video is around a family investment company and the practicalities of how it works in a real world practice. So, how does a family investment company work in practice? So, a family investment company is a simple, normal, limited company, but with bespoke articles of association and multiple share classes. So effectively, you are paying when you set it up for the legal work to change those articles of association, set up strong shareholders agreements and multiple share classes in order to suit how your family is set up. Now, the company is usually set up on a limited basis, but it can be unlimited if you only want to hold investments and not any property. Now, it's specifically set up by the tax consultants in our company together with our lawyers, and we set it up in a bespoke manner to match the family who is embarking on this particular strategy. Now, the people who set up the company are directors of the company and retain control of that company for life, irrelevant of who owns the shares, which is important for inheritance tax planning, as you will see later. Now, often it's used by people who have large property portfolios, especially where there are significant capital gains tax issues. So watch some of our videos on family investment companies and landlords to get an idea of how that works. But people gifting the properties into the company will have A-class shares, and those shares are then put into an employee benefit trust using holdover relief to avoid immediate capital gains tax being payable, and then those shares are retained in that employee benefit trust for the remainder of the lifetime of the people putting it in, and thus avoiding the capital gains tax. And the day the shares are put into that employee benefit trust also avoids the inheritance tax. So family investment companies are also very useful for people with large investment portfolios, especially for people with assets of over 2 million and above. Now, cash can be gifted into the company, and that's offset on your balance sheet as a director's loan or shareholder's loan. And the director's loan can be repaid over time completely income tax free because it is a return of capital. So somebody puts £1 million into their company, it generates a 5% return. They can draw that £50,000 out every year for the next 20 years, effectively free of tax, providing of course they live that long. Now, corporation tax is payable inside the company, but below 50,000 it's still at 19%, which is a lower tax rate than people who are paying higher rate income tax. And if you don't need the income out of your company, then of course you then don't have to withdraw the money, and then depends upon the corporation tax as to how much money is in that company. Now, around age 78, if you've got directors' loans still with you, then you should potentially consider giving those up to your children, and that is a potentially exempt transfer. So after 7 years, that gift is outside of your estate. But the children can now get that tax-free income from your company. Now, once you've given up the director's loan, you could of course continue to get income from the company just as normal dividends. You could also use the company, if you're not using the income stream, to make pension contributions. This is especially useful for people who want to invest in commercial property, for example. You can put pension contributions in, buy a commercial property, then all the rental income on that commercial property is effectively tax-free because it's inside the pension, and the growth on that property, that commercial property, would also be tax-free as far as corporation tax is concerned because it is for the company. So you get landlords who are building property portfolios in their company and then building commercial property portfolios in their pension, and that actually is a very useful way of tax planning. Now, when the company is set up, normally we would set up different share classes for your children and grandchildren. So children, when we set up the company, will get income shares, and therefore they can get dividend out of the company if you want to give them any, provided of course they are over 18. However, grandchildren can get income from the company to use their personal allowances tax-free even if they are not 18. So your children will get all the future growth in the company, and the value of the assets, that stops the IHT issue from getting any worse. So all future growth is allocated via something called growth shares to your children to stop the problem getting worse. All direct descendants can own shares, but their spouses can't, and that protects the assets in the event of a divorce. Our other videos cover how that works. So an FIC can also reduce income tax levels because obviously you don't need to take all the income out and just leave it in the company. And it can also avoid IHT on large estates while still retaining control in the company. However, there are no silver bullets. You will have to pay an annual accountancy fee to manage the company, but really it's no more expensive than any other company. I would say, however, you should not rely only on a family investment company to solve your inheritance tax issues. So you should consider the use of a maximum investment potentially into a flexible reversionary trust, because if you give the shares of your company away, which you will need to get it outside of your estate, then what are you going to use for capital? And therefore, the flexible reversionary trust will help you to solve that problem. You could, however, also put a certain amount of money into business relief plans, which are outside of your estate after 2 years. So, family investment companies are a very useful vehicle for inheritance tax planning and other planning vehicles, and you should certainly talk to an experienced practitioner to understand how it works. Hopefully you found that video useful. If you did, give us a like. Watch some of our playlists on the YouTube channel if you want to know more about family investment companies. But thanks for listening, and goodbye for now. Bye.